Hey, welcome in. It is the GenWealth Radio Hour and our online live stream. Welcome in for the next hour. We're going to be talking about what's happening, the headlines that you need to know about, and really, we're diving in today on the fear and the noise that's being peddled out there on social media. My name is Scott Inman, along with me, GenWealth co-founder John Shrewsbury. We'll have the Get Ready for the Future show later for our GenWealth Radio Hour listeners, taking your questions about money and finance and retirement. But, John, we dive in with the What's Happening segment. That's been a new feature to our Radio Hour format now for several months. And today, I think there's a theme. Today, it's about, man, and I spend a little time on social media, less and less, as it seems, week to week, because of the impact, and because it affects me.
Yeah.
I do this for a living, and when I read, because I follow a lot of stuff about finance, and there's a lot out there, I think all the time about fear and why you shouldn't invest and those types of things. But there are times where it really ratchets up. And I think now is a time, based on economic data, based on all-time market highs, that we have really entered that pattern of where the sky is falling for a lot of people.
Yeah, and I'm going to preface this whole segment of we've got opinions and aren't afraid to use them.
Yeah.
So these are opinions,
Right.
but I think that they are well-learned and well-read opinions, because you and I both spend a lot of time digging into things that most people go, that's geeky. You know, I don't, why would you do that? But there is an element of fear that I think that we've got to come to recognize when it's being applied to us.
Yes.
And when we are being bombarded by people who live in fear. And that can just wear your butt out. I'm just going to tell you, it will. And I think that oftentimes, you know, there is a element. I am not a Pollyanna by any stretch of the imagination. I'm very much a realist, but I also will not allow us to live in fear, because when you live in fear, you lose. Mm-hmm. And I think our first little story here is kind of the Pied Piper of fear in the finance world.
Yeah, we take a look at this, and this was on published by Yahoo, a Yahoo Finance article. Peter Schiff, maybe you've heard of him, warns of a U.S. economic crisis that will make 2008 feel like, quote, a Sunday school picnic. And it talks about an asset that he loves. We're not really going to get into that. But let's talk a little bit about that, because I've seen a lot of Peter Schiff on my social media feed.
Yep.
He's getting a lot, and maybe he's getting more press than he normally gets. I don't know why it's popping up in my feed more and more these days, but let's get a little background on Peter Schiff. He became famous for predicting correctly the 2008 financial crisis.
Yes.
But he has always, since the dawn of his career, been predicting a collapse.
Peter Schiff is the subject of a joke in the finance industry, and that joke is he has predicted 20 of the last 2 recessions.
I like that. Yes.
So
a broken clock is right twice a day.
That's right.
Yes.
And Scott, let's go back to our background in journalism and media and what have you from our past careers. You know, there's an adage in the media business. I don't know if it's still kicked around like that, but it is, if it bleeds, it leads.
Yeah.
And I think that anytime somebody is, if you will, bleeding on the economy, saying, you know, things are bad, really bad, they're so bad I can't even begin to tell you how bad it is, which is essentially what Peter Schiff is saying here, you got to go, okay, who is this guy? And does he have a track record? He got something right one time in 2008, but he has been predictably wrong about the U.S. economy. He's been predictably wrong about Bitcoin. He's been predictably wrong about a lot of things. So, you know, I immediately go, okay, does this guy have any credibility? Regardless of what he may be saying, does he have any credibility? Does he have a track record? Why should I listen to him? And I, you know, when Peter Schiff's name is attached to anything, I immediately go skeptic right off the bat as to whatever it is he's saying, because he comes from a worldview of everything is bad and it's going to get worse.
Yeah, I think you have to know your source when you're seeing all these things that bombard you every day on your social media feed, or even in this case on legitimate news organizations. So he gets a place with Yahoo Finance to put that. Now, let's talk a little bit briefly about what he's saying and why he believes this, or why he says he believes this, because I think there's some challenge there too. I think there's a lot of just getting the attention is what matters more than what he's actually saying.
Sure.
And I don't know Peter Schiff personally, so maybe I shouldn't say that, but that's what you got to really think about. So he says the U.S. economy is built on a dysfunctional, consumer-based credit economy that's propped up by the dollar's role as the world's reserve currency. So he says this is going to collapse. And one of the reasons he points to is the astronomical rise in gold and silver prices, precious metals. There's no question there have been huge flows into purchasing precious metals. And that is, I think it is big enough, John, that it gets our attention. I'm not going to say that there's nothing to that, but if you read enough, we know that that's a real result of a lot of central banks moving huge assets into that category. And typically those are seen as a hedge against bad economic times. But that in itself, I don't know how he connects the dot between that and an all-out collapse.
Well, and I think that you have to, the inconvenient truth of surrounding this that Peter Schiff is saying is that, U.S. economy and the markets, the companies that make up those markets are doing okay. They're productive.
Mm-hmm.
Their productivity, their profits are good.
Right.
The cash flows are stable. They've got a lot of cash on the books. What is the catalyst that is going to make this happen? That's what he really avoids here. He doesn't really say, what's the trigger, what's going to happen here. I think that he is just the Pied Piper. Again, he is that boy that cries wolf all the time and really doesn't have a legitimate basis for doing so other than, I don't like the debt. I don't like what's going on. Well,
I don't like it either.
I don't like it either, but it's been going on for 40 years.
Right.
And, I understand that at some point in time there's a tipping point in that, but I'm not real sure that we're at that.
Right.
And I think what would tip that is economically we start really suffering, something happening in the economy that would cause profits to drop. Mm-hmm. But I just believe fundamentally that anybody that has bet long-term against the American economy has consistently failed. And that is the premise of the investment thesis that we have at GenWealth, is that equities for the long term work out just fine. And you know what? Maybe he was right about 2008, but you know what? We survived 2008.
Exactly. That was my next point. Yes. So he even the one he was right about, if you had followed his advice day in, day out, year after year, you would have missed out on huge returns in the stock market. And to John's point, I think this is a lot like, as we close the book on this, a lot like end times prophecy. The Bible says nobody's going to know, right? So why are people out there saying
why are you worried
happen?
about it?
So
the game is what the game is. Keep playing the game until the game changes.
That's exactly right. All right, second up on the what's happening segment. Private sector hiring slumping in January, adding just 22,000 jobs. This is a CNN article, and this was published on February 4th, and we sit here today on February 11th. So a week ago, there was a CNN published report that said the U.S. private sector job market sputtered at the start of 2026, adding just 22,000 jobs in January, far fewer than economists expected, highlighting continued weakness in hiring even as wages grow. Obviously a very negative article. Not going to question the sourcing of that, but we do know that was a private sector jobs report, okay? Here we are a week later, live to you on February 11th, and we've got another report from the same month that says, from the government, that payrolls grew by 130,000 jobs. So the discrepancy, 22,000 a week ago from one survey, 130,000 today from a government survey, and the unemployment rate even dropped. Not significantly, but 4.3% is where we sit now. So you look at that, John, and you look at, this is a classic example of the data can change, and do not make investment decisions on any data.
Well, that's exactly right, Scott. I would bet, I didn't go back and look at this, but I would bet that we probably had some sort of market reaction when that first report came out. And there's probably a market reaction going on right now to this report coming out.
Yep.
And that's the thing that I want to get across to our listeners today, is that your investment decisions should never be made based on what the news is, because the news changes. And you know what? People get things wrong. I'm not saying the CNN report was wrong, but obviously there was a big revision or whatever. There's a big gap between 44,000 and 130,000 jobs. It says something completely different about what's going on in the economy. So if you made a decision based on the 44,000 report, maybe you made the wrong decision, and now today maybe you're missing out on, the benefit of what is actually happening in the economy.
Now, it did say, even the good news jobs report did say that they were concentrated in two industries, construction and healthcare, and so there was some hesitancy to say this is as good as it looks. With the 130,000 jobs, which is really always, if you dig into the data, there's going to be some good, there's going to be some bad, there's going to be positive and negative. But another point, even in the CNN article that I thought was good, was it said the average pay went up 4.5% year over year. Wages did. And job changers, somebody who got a new job, got a 6.4% raise on average. This is good news, because now that is above the inflation rate, significantly above the inflation rate. So this is how we catch up. When we hear about inflation, and cost of living rises, that is how you beat it, is get a higher paying job. And for a long time, that was difficult. But now we're seeing that pendulum swing.
I think what this says, when you think about where people are, and we're actually going to talk a little bit about the cost of living and things of that nature, and we'll segue into that with this comment, Scott. But I think that we are living in a time that you can't sit and be content with where you are. I think that you have constantly got to be thinking about improving yourself, growing yourself, and reinventing yourself. I was actually listening to one of our brethren financial advisors, Rick Edelman. He was on a podcast the other day, and Rick is a futurist. He thinks about all these wild things in the future. He's a big proponent of Bitcoin and everything, but he's also very into this whole aging thing. And he talks about the fact that, retirement as we knew it, let's just say 10 years ago, is an old, dated, really out of vogue thought process. That people are living longer, people are reinventing themselves through education. It is like a second career when somebody hits 60 or 65 years old, and now they've got money that really kind of changes the game and puts them in a position where they can go do anything that they want to, because they have the resources to support their basic living expenses, and they can go explore things that maybe they didn't have the opportunity to, because they had this income requirement that they were meeting with their job before. So I think that oftentimes we get in this loop of thinking about, where we are in terms of, the economy and the investments, and we got to hit this target so I can live the rest of my life on my money. Yeah. And that is becoming more and more an outdated thing. For years here at GenWealth, we have talked about work-tirement.
Yes.
And that being a situation where there is this hybrid existence that you have for being able to work some and live some. And that's what I think that most of the people that come in and talk to me anyway, and I'd love your input on this, most of the clients who come in and talk to me that are in their 60s, they're not done. They are very much going, what's next for me, and how do I craft what I have into something that supports that?
Yeah, I remember when I first started here, probably the first year I was on board at GenWealth, that we talked about retire the word retire.
Yes.
Right? It is about financial independence. It's
That's
not
right.
necessarily, some people are done. Some people because of health or just because they do not like what they do, they're done. It's a full stop. We work with those people too. But to John's point, a lot of people are not ready to retire, but they want financial independence. And the next one we have, I know we're running along, Casey, apologize for that, but the What's Happening segment's going to be a little lengthy today. I want to show you a reel that caught our eye about how young people are feeling. Take a look.
Not the overspending, it's the cost of living. Here is a breakdown of the average Gen Z and millennials' cost of living in today's world. So number one is rent. Everyone knows that Gen Z and millennials have to have a roommate. So splitting a 2-bedroom apartment with utilities is around $1,500. If you have a car, a $12,000 to $15,000 used car is still going to run you $400 a month. Car insurance and gas is another $300. Student loan payment, $500. You're going to have groceries for $500. You're going to have personal care, doctor's appointments, hair, gym, about $150, and then cell phone and miscellaneous $150. That's $3,500 a month, which is baseline. Do you know how much $3,500 a month is? $70,000 a year, or $34 an hour. Because after you take out taxes, put $300 for health insurance, and do a healthy $500 401k contribution, that leaves you with $3,500. This is no fun, no savings, no maintenance, no clothes, no kids, no traveling, no vacations, no bachelor parties, no weddings, no funerals, no clothes, no school supplies, nothing. And this is paycheck to paycheck. And on top of it, they're holding $40,000 of student loan debt, a $15,000 car, and if they ever wanted to buy a house with closing costs and a down payment, another $50,000. So they need $105,000. So even if they were somehow able to scrounge up after $70,000 of paycheck to paycheck, $5,000 to go to a concert, to have avocado toast, whatever it is, $5,000 a year, it would take them 20 years to pay off this debt and save up for a house. 20 years of living with the roommate where that rent's going up, and they're making $70,000 a year as a college graduate. The average person in this country makes $50,000. It is not the overspending. It is a cost of living crisis.
Whew, I tell you what, that could be depressing. That's demoralizing if you listen to that. I appreciate the guy. He was very good. First of all, when I react to that, I think the first thing I think about, it certainly depends on where you live. Because the first thing he said was, with a roommate splitting rent, it was $1,500 a month. My son lives in an apartment by himself for $995.
Yeah.
So, in Arkansas, I think that's a little bit different. So, but again, this does highlight, where you live matters, choosing where you live. And that is a problem. I told you before we went on the air, I read a book recently about how people are leaving the rural areas. Rural areas are dying all across the United States. Everybody's moving to cities. Younger people are all moving to cities because that's where the jobs are. And I understand that, but you have to weigh that choice for sure with, can you afford it? But I'm not going to discount the higher cost of living piece to that. It is going up. Inflation has cumulatively really cost us, and I get where he's coming from on that, but I don't hear him offer a solution, right?
Well,
that's what's lacking there.
That avocado toast, that was the
that was good.
That was the deal breaker there.
Yeah.
But obviously, there are economic pressures. But you know what? There were economic pressures when we were in our 20s and 30s. Yeah. It was tough then. Our wages were way lower than they are right now.
Yep.
And that again goes to the what do you need to do to improve the situation?
Yeah.
There's nothing you can do to change the economy.
Right.
That's not the deal. What you've got to do is you've got to say, how can I get a better job? How can I make more money? How can I be more disciplined in my spending? How can I save more money? All of those things are things that I think that people don't want to hear, but that is the real truth.
Yeah, it's about your economy, not the economy. So when you think about it, if you're in a negative cash flow situation, which is really the whole point of that, right? They're underwater. You got to do something to either lower expenses or raise your income, or both. That is the only solution to that, the only way out. And I think lowering expenses, take a hard look at your essential costs. I think what he put up there were essential costs, but not everybody's in that situation. They may consider their Netflix subscription an essential cost, right? It may not be something you can do. The $400 a month payment for a used car, get a more used car. If that's too much to pay for a car.
And I was thinking about, when we grew up, we didn't have cell phones. $150 to a cell phone. And I understand you got to communicate, and I understand that the phone on the wall in the house is an archaic concept.
Yep.
But if you got to do it, you got to do it.
Yeah. So I understand where that is. We have great sympathy for it, but there is only one way out, and you have to set goals and make a plan to do that. Because here's the deal, costs are not going to go back down. You're going to have to increase your wages, as we talked about on that last piece. You got to have that 4 or 5%, 6% wage increase, whether it's job mobility into something new or your current employer, to be able to outpace that cost of living. But it is different. I'm not going to argue with that. It is harder for younger people today, but there is always a path out. All right, we went over. We know we were going to go over.
Okay.
We're going to wrap up our opinions and what's happening to get ready for the future shows next.
You been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Helping people discover, protect, and share true financial independence. That is the mission at GenWealth Financial Advisors, and it is why we are on the air with the Get Ready for the Future show. My name is Scott Inman. Thank you for joining us. Getting ready to take your questions alongside GenWealth co-founder John Shrewsbury. You ready to dive in?
Yeah, let's do it.
All right, Holly from Benton is our first question on the show today. I've always managed our finances, but now my health is declining. How do I make sure my spouse is prepared to take over? If you are the household CFO, Holly, a transition plan isn't optional. It is essential. And first off, thank you for asking this now instead of waiting until the crisis forces it. But I'll start off by saying this from meeting room experience. I really believe that we have acquired clients partially and sometimes majoritively off of this reason.
Yep.
There has been a household CFO. It's typically the man. I'm just throwing the stats out there. And he has been running things, and he knows that his wife doesn't have the same acumen or the same desire in most cases. She may have the acumen, but she doesn't have the desire to handle all of that. And he understands that when he is gone, she's going to need somebody to lean on. So I think the first response for me, or first reaction, Holly, if you're not working with a financial advisor, this is the first step. Find one you can trust, because the spouse doesn't need to do it alone.
Scott, I can't tell you the number of times that I've sat in a meeting room and went, man, if he dies or she dies, he or she on the other side of the equation is in trouble.
Yeah.
Because they're clueless. They didn't want to know anything about it. They were there because they had to sign their name on the paperwork or whatever the case may be. That's been a constant theme in the 30 years that I have been in the financial industry. We see it all the time. So what is the solution to this? How do you work around this, especially in a situation where you can kind of see the trouble coming?
Yeah.
Sort of like Holly intimates in her question here. I would say that there's really two possibilities. One is a campaign to educate and to grow. And I think that's where a financial advisor can come alongside the husband and the wife and be there and build a relationship with that other spouse, help them to understand some of the concepts that are being discussed in the meeting room and being discussed about their finances, and be in a situation where at least there is a good level of trust and give and take between the lesser knowing spouse and that financial advisor. I do want to really put forth a word of caution here, that what you don't ever want to do is to turn over the responsibility of being the household CFO to the financial advisor. Because then you get into conflicts of interest and maybe even worse. When you have an unknowing spouse and maybe the other spouse passes away or has to go to a nursing home or whatever the case may be, then all of a sudden you've got a vulnerable situation, and you never want this third-party financial advisor who benefits to some degree from the situation to be in charge of it. Now, another family member coming alongside you, that's a possibility. A child or what have you, an adult child coming into the picture, that is certainly a possibility. But let's err on the side of caution here and talk about educating that spouse, Scott.
Yeah, so I think first, before the education, is the inventory. Pick up all of the things that you control in your finances and figure out your accounts, your bank accounts, your investment accounts, retirement accounts, insurance policies, income sources, debts, and make sure that your spouse knows how to access that, because sometimes they haven't even looked at it. They have no idea about how much they are bringing in or how much they have invested.
Can I use a 2026 example here that I think is very apropos? And most people don't even know what this is, but I'm going to throw it out there. There are programs called password managers.
Yeah.
And I think it can be an invaluable asset to the other spouse, that if something happens to you, that they know where the passwords are. And this password manager is electronic. It automatically fills in. You have to log into the password manager. There's one password you have to know.
Right.
We use a password manager at GenWealth. We have, I don't know, 5 million different things that we've got to log into, right?
Adding every day.
Yeah, and we use a password manager.
Yeah.
So there is no reason why you shouldn't do that with your own personal accounts. The other thing about a password manager, Scott, and this is a little bit off the subject, but a password manager can give you these random passwords, keep them inside the secure password manager, but it makes it almost hack proof in terms of, because here's what most people do. It's their, I don't know, their spouse's, nephew's name or something like that, or their pet's name or whatever is there. And they use it for everything.
Right.
And once you get into one of them, you get into everything. So I think that is a safeguard both for the familial situation and for the potential of somebody hacking somebody's accounts.
Yeah. So once you've done that inventory, the next stage would be to introduce, but don't dump. Do not throw a financial fire hose in front of your spouse and give them too much to digest. So regular low pressure conversations might be the rule of the day there. Do some money check-ins, just kind of work through that and show how you do things to your spouse. Identify the decision makers. We already talked about, if you do have a financial advisor, make sure your spouse knows who that is. Hopefully they're attending the appointments with you. But we do have that oftentimes in the meeting rooms, where the first time we meet, we only get one of the spouses, and we communicate that to that spouse, that we'd really like your spouse to be involved in these appointments, even if she's scrolling Facebook. She's in the appointment, or he's in the appointment, to be a part of that, the decision making and the planning. Who helps with your taxes? Do you have a CPA? Who helps with estate planning? Do you have an attorney? And the great thing about GenWealth is we're offering, or at least offering, connections to all of those services.
That's right.
Yeah.
That's right. And Scott, I think that there has to be some thought process put into, when the time comes, how do you make this transition? How do you get from this person being in control of it to this person being in control of it?
Yep.
And maybe that's a give over, slowly, of different things. But I think there are things like powers of attorney that need to be in place.
Yep.
You need to be sure that beneficiaries are up to date, and also that trusted contact. That is something that we are very vigilant about at GenWealth, that if there is something wrong with a client that we can't reach them, or they sound really weird on the phone, we need a trusted contact that we're authorized to talk to about whatever the issue is on behalf of that client. Those are all kind of checkpoints that I think are important in this equation.
Hey, if you want more free info about retirement, investments, and your money, you can subscribe to our YouTube channel. Just search for GenWealth Financial Advisors and subscribe for all our latest videos. Next question is from Hank, and he writes via email: we recently moved from Texas to Arkansas. Do we need to update our will or estate plan to match Arkansas laws? That's a great question, Hank. A new state might mean new rules, and your old documents might not be holding up. So we're going to talk a little bit about how to make sure your estate plan still works. The short answer here is yes. At a bare minimum, you need to review it, because a move can quietly break an estate plan without you realizing it. So you think about it, they are state specific, right? In plain language, wills, powers of attorney, and healthcare directives are governed by state laws. And Texas and Arkansas have different probate rules. So if you don't have a state plan set up to bypass probate in Arkansas like it did in Texas, there is that possibility, different language requirements. There is certainly a need anytime there's a big change in life, period, to review your estate plan.
Especially if you are moving to or from Louisiana. It is Napoleonic law in Louisiana as opposed to the laws that we have elsewhere in the United States. And so it is really completely different. When we started doing business and acquired a practice in Bossier City, Louisiana, we learned of a whole new registration that was available in Louisiana that was not available in Arkansas. Arkansas. So the laws are definitely different. So I think that you really have to think about the fact that, yes, your documents do still exist, but that doesn't mean they still work. And so clearly a review of this is important. And this is not something that you want to be, close enough on. This will do. It'll be okay or whatever. You want the right thing to be in play there, Scott. So it does beg for a review.
I would also kind of extend that question out to you. What else do you maybe need to review when you're moving states? This is a huge life change, and we are big believers that anytime there's a life change, all of your planning documents need to be reviewed. You think about beneficiary designations, you think about titling, you think about contingent beneficiaries, and really even looking at retirement. Do you have a retirement plan, and what does it look like, and how is it changing? We don't know why Hank and his family are moving from Texas to Arkansas. It may be a job change. It may be for retirement, but maybe downsizing their home. There's all kinds of financial reasons here that could change his retirement plan.
Well, and also, if you're moving from one state to the other, obviously you're selling a house and you're buying a house.
Yeah.
Be sure that the new house, if you have a trust, be sure the new house is titled in the name of the trust. That is something very easy to overlook in that transition, because it may be the title of the house was held in the name of the trust in Texas. You've now moved to Arkansas. The new house needs to be titled in the name of your trust in Arkansas for it to continue to be effective. Otherwise, you've got a probate issue potentially there. So clearly, Hank, thanks again for calling in and letting us touch base with you on this. But, I think, Scott, this is a great point to point out. The estate planning services that we have at GenWealth, and the ability for our estate planning specialists to overlook some of this stuff and help you in a transition if that's going on in your world.
Yeah, if you've moved, Hank, it's a good time to step into that and get that estate plan reviewed. And if your attorney's back in Texas, you could seek out new estate planning services, and we do have that here at GenWealth. You can reach out to us and call 866-653-PLAN, 866-653-7526, or send an email to info@getreadyforthefuture.com, and we'll be able to talk about our estate planning services and whether it is right for you. This is our question of the week, too. So, Hank, we want to send you a free Get Ready for the Future Show tumbler for being the question of the week. You can email us to show@getreadyforthefuture.com to claim it. We'll send that tumbler out to you. And I will say, just to wrap this up, since you're moving from Texas to Arkansas, welcome to state income tax.
There you go.
Yeah, that is. So if you are moving because of a job change, I'm sure, as you already know, that's coming for you as well.
Smaller than it used to be, but still there.
It is smaller than it used to be. And potentially property taxes are a little lower, too.
I would think so.
All right, our next question from Colleen in Little Rock. I'm 52, and my company matches 6% in my 401k. I'm contributing 10%, but should I be doing more or putting extra into a Roth IRA instead? Colleen, thanks for the question, and a great match there for your 401k, and you're doing great by putting 10% in. But when you ask, should you be doing more and should you be diverting some into a Roth IRA, it's hard to answer that with no more information than we have, because, Colleen, you haven't told us how much you have currently in your 401k. We also need to know, Colleen, at 52, how much longer do you plan to work? Because the obvious answers will come from getting all of the data input. And what you really need to know is not how much do I need to contribute first. That's not the first answer. The question you need the answer to is, how much income am I going to have when I want to become financially independent?
Yeah, I think the income question is the number one question, but let's talk about this Roth versus 401k question for just a second. I think that the first thing that I would do if I were Colleen is I would be knocking on my HR department's door and going, hey, is there any way that we can get a Roth 401k? Because I am more and more and more convinced, Scott, that Roth IRA dollars are incredibly incredibly more valuable to your family and your financial independence than traditional IRA dollars are. And I know that kind of just flies in the face of how things have always been over the years, but the Secure Act changed all of that because, yes, you do get a tax break on the 401k, traditional 401k dollars that you put in, but that tax break is really minuscule compared to the tax impact on paying taxes on all of that money accumulated over your lifetime as you retire, and the fact that your family is going to have to, if your kids inherit your retirement assets, they're going to have to pay that out over a 10-year period of time, and the tax impact of that is going to land squarely on them at a time when they're likely to be making more money than they've ever made before. Therefore, that IRA is going to be taxed at a higher tax bracket. So I think that that's the first question that I would be asking. But let's jump back to the issue of the income calculation first.
Yeah. So let's connect the dots here. So look at the income. How much are you going to need, and how much are you going to want on a monthly basis at the day that you retire? So if you're 52 now, Colleen, and you want to retire at 65, we've got a pretty good time horizon to build more wealth. Is 10% of your income enough to accomplish that? We need to determine that first, but coming to a plan that is created, a retirement income plan that shows you how much income you can get and how much your assets need to reach, what level your assets need to reach to produce that income is going to allow us to back into how much you need to contribute on an annual basis. Now, once that number is set, and it's an actual number, and I really get so frustrated about always 401ks requiring that you determine how much you want to put in as a percentage. It needs to be a number, really.
Yes.
I mean, it needs to be a number.
It really does.
It doesn't need to be a percentage, but that's the way it works. So you're getting a 6% match. We would say that, let's say that your 10% is enough, and that's going to get you to your goals. The 6% for the match needs to go in first. The other 4, I think, as John's already alluded to, we need to find a way to funnel that into a Roth account, whether it was a 401k or whether it was a Roth IRA, for the reasons you mentioned. And I think people do forget that. I do think there are limits to that. If you are a high earner, that the tax break now is going to be more beneficial. But if you're a high earner, you're not eligible for a Roth IRA anyway. So,
that's right.
So if Colleen is eligible for a Roth IRA, I think that's where she needs to go with that other 4%.
Yeah, I would agree. The Roth IRA gives you tax-free income when you retire, and if you still have traditional IRA money, you can kind of blend that together to lower your overall tax bracket in retirement. But the big deal is that you can pass that Roth IRA on to your family tax-free.
Yep.
Yes, I said tax-free. Tax-free income for you, tax-free inheritance for them.
Yep.
And that is income tax. I'm not talking about an inheritance tax. I'm talking about an income tax because the income tax is what applies to IRA money, Roth or traditional, doesn't matter. The question is it taxable or not from an income standpoint? And so that's the big deal. And as I said earlier, Scott, the Secure Act was a big game changer in this, and it does really dictate how you think about that. And I'm very happy to say that we're seeing more and more Roth 401k options out there in the marketplace. Mm-hmm. And I'm hoping that people will take advantage of that and not just look at the tax break, the small tax break that you get there, in deference to the big tax break that you get down the line from contributing to the Roth.
Yeah, so as we delve kind of more into that, and I do want to talk a little bit about the differences in the 401k versus the Roth IRA. So let's assume right now Colleen only has pre-tax as an option for her 401k and is looking at that Roth IRA as opposed to putting more pre-tax dollars in the 401k. There are some limitations for the 401k. Investment choice is limited. The average 401k has about 10 to 12 funds, and I've seen as few as 5 or 6 in someone's company plan. There may be nothing wrong with those funds. They may be low cost when compared to outside in a Roth IRA, but they're limited. So certainly there is more of the investment universe that opens up when you look at a Roth IRA. You have more control of it. And the distribution rules when you do reach retirement can also be somewhat limited. I've seen so much of this. The two biggest problems I have with taking distributions in retirement out of a 401k is oftentimes there is a mandatory tax withholding of 20%, which may or may not fit you, right? You may have to deal with that because you really don't want to be paying more tax on a withdrawal than you need to in retirement because you're going to have to withdraw more gross, and that's taking money out of the money you have invested in the market. So setting your tax brackets and your tax withholdings as accurately as possible is very important. The 401k is often limited in that. And then the other thing, John, that I really dislike about 401k distribution rules is most of the time it's going to be a pro rata withdrawal. They're going to take a piece of everything you own. So if you have still 60% of your 401k balance in stock-like investments, and that drops 20% because we go into a bear market, you're pulling out as the value of those shares is going down.
You make great points there, Scott. Let's be sure that we level set on this. A 401k is a wonderful vehicle, despite what TikTok might tell you. 401k is a wonderful wealth accumulation vehicle. It doesn't do so well in a distribution phase. It's not built for that. It is built to help you accumulate money from your paycheck as you work through your employer to get a match and all those things. 401k is a great vehicle to do that. But when you are ready to retire, then you want full control over everything that you've got and the ability to set the parameters, just like Scott was talking about, not only from a tax standpoint, but an investment standpoint. If there's something that is attractive to you investment-wise, you don't have to depend on the 401k to have that investment in there if the money is in an IRA or Roth IRA account. So looking at that from a transition standpoint, Scott, I think makes all the world sense for people who are trying to kind of figure this out. Now, let's just also say that there is no universal answer to this. The thing that you want to do is you definitely want to avoid those rules of thumb. You know, what percentage do I need to be putting in? And am I putting in enough if I do this or whatever? You have to do the hard math and figure out what is it that's going to get me to where I want to go. Because if you're not going to get there, then whatever you're doing is not going to work.
Yeah. And when you're 52, that's more of a clear vision than it is when you're 22, 32, 42. You can really set those targets, and certainly they're movable over time. It's not rock solid and set in stone, but it gives you an idea of the course you need to chart.
Well, let's also talk about how you kind of overcome this, because we've thrown a lot at somebody. I think the key here is to sit down with an advisor, and particularly an advisor that is gifted and talented in the area of retirement income planning.
Yeah.
Not every advisor is that way. Just because they have financial advisor behind their name doesn't necessarily mean that they know all of the ins and outs of retirement planning.
Yep.
At GenWealth, we have folks that have done retirement planning for decades. And so we know retirement planning. We have the opportunity to do that. And I think that is the key to solving this problem, is that you want a customized solution. You don't want a rule of thumb or a cookie cutter solution.
Yeah, I was thinking about this because it baffles me sometimes, John, that so many advisors who are in the financial services industry are still laser beam focused on investments, and that is it. But you know, the reality of that is investment advisors are compensated based on the investments.
That's right.
So that's how they get paid. So it's real easy to get focused on just doing the investments. But to provide full service to someone who is asking the questions that get asked on this show, you need to do all of the other things. And that's what we do here. We use planning software that can evaluate whether it's right for you to do a Roth conversion with some of your pre-tax dollars. That's a great segue into what we were talking about here, because somebody may be listening and saying, well, it's too late for me to put in a Roth IRA. I've been doing pre-tax and I'm 65 years old. It may not be too late. It may be an option for you to do Roth conversions in your early years of retirement. We have planning software to show you what effect that would have on your overall portfolio. But we're out of time, though. We're out of time. You heard the bell. Final thoughts time.
So final thoughts are that there is so much in terms of your personal finance that, you know, when you pay attention to kind of what's going on. We talked early on about all the noise that's out there and all the things that you know, you get told about things and all the rules of thumb and all of this type of thing. Understand that none of that matters. what matters is, like we're fond of saying, your economy, not the economy, your economy. It's not the rules of financial planning. It's your rules of financial planning. It's the things that you need to commit to, that you need to look at and go, I am going to be all in on this process because it's a big deal. It is my living for the rest of my life. It is my financial independence. It's what will fuel that second phase of your life, so you can go and do all those cool things that you've thought about doing and dreamed about doing, and that you do have a second bite at the apple, so to speak. That's what financial planning actually enables if you go through the process.
So my last thought is, if you don't have an advisor, you're not working with somebody, or if you do have an advisor that is only focused on investing and is not giving you full service from a planning perspective, talking about tax diversification, talking about retirement income and those types of things, I want to invite you to go through the GenWealth Ready to Retire process. Costs you nothing. You don't have to make a decision about moving. You can just have a discussion. Call 866-653-PLAN. That's 866-653-7526, or email us info@getreadyforthefuture.com. And that's all the time we have for this week's show. Thank you for watching if you were online with us, or listening if you were on the radio or on podcasts. See you again next week, and if you got a question, send it in. 501-381-5228. Leave a voicemail or a text, and we'll see you next time.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com, or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.